Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony.
Now, Evan, we're racing towards the end of the year. I just wanted to really look back at what's happened over this year on an economic front, what that really means for investors. It's been a really busy year and a very interesting year, and in many respects, a very challenging year, let's put it that way.
Has been a challenging year. There's been two parts to it too, in terms of the really big thematic that's come out of this year is growth and inflation. So if you look back at the year and look back at where the excitement was and where the disappointment is, it's in those two sectors. So growth, a lot of people put down this year, and the pessimists will really put down that growth this year has been driven in the main by government. I mean, government spending all through the year has been very, very solid. In fact, without it, it would probably, particularly Q1 and Q2, would have been really weak. But the other side of it, the positive part is net exports. And we've spoken about this many times, is the Chinese surprise that has been this year, the demand for things like iron ore, copper, coal, and the real movement in commodities and commodity prices has been a big benefit for us. So we actually continue to get away from the idea that we're now into, 26 years since we've had a recession. There was threat that it could happen after Q2 contracted slightly. But in saying that, growth has been reasonable, and growth into 2018 looks pretty good as well. But again, it's net exports. What has happened, and continuing on the growth story, is that the other side of the data this year that's been a real interesting inflection point, again, positive and negative, business versus consumer. And business investment, business conditions, business spending, blah, 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 has slowly but surely over the 12 months this year has been getting stronger and stronger. And that probably culminated this month with our CapEx numbers, and which have been building through the year, that showed that we're actually now at the highest level on future expectations in the last 4 years, which is a real positiveness. The catch on the other side has been consumption, and this gets to the inflation stuff, and also maybe why some people are pessimistic around growth is because consumption's under pressure. That is clear as well. Is that the other part of growth story around the GDP figure is consumption, and consumption is clearly slowing down, and that gets back down to inflation. And inflation this year has been probably the cold water story, in that wages we know about and how important they've now become to everything everybody talks about in economics. Wages hit a record low in Q2, popped up ever so slightly in Q3, but they are at record lows. Let's be honest, at 2% wage inflation, 1.9 in Q2, that's really weak, which means realistically the majority of Australians, barring those in the public sector, are only getting core inflation, which is sitting at 1.8%. So it's been a real year of push and pull. Which wins out? It's not really that sort of answer. It's more inflation therefore keeps monetary policy at bay. Growth will therefore come from the global story. Is there going to be pockets of bubbles on the back of that? That's what everybody's asking for next year.
Yeah, and we'll get to next year next week, because we're going to do a 2018 outlook piece, just looking at what investors need to know in terms of, economics. What are going to be the key drivers, what impact that's going to have to flow through. But getting back to this year, as we've talked about probably dozens of times now, interest rates in Australia at least have flatlined, and there's been all these pressures around the Reserve Bank putting up rates, but then on the other side of the coin, the argument for putting up rates hasn't been there for the Reserve Bank.
And the pick up on that is, let's completely agree, and that's what we discussed last week, is why the RBA will now break a record. We are going to break records in January for the longest period of not moving rates in either direction. So we've gone 16 consecutive months. Come January, it'll be 17. That can't change because they don't meet until February. But the other interesting sort of look at that is that the reason the RBA is getting really pressured into raising rates is, the debt to income ratio is clearly one of them, the housing market and the frothiness that's been inside of it, all those kind of ideas, the ease of money and the accommodation period just gives us no room for, if there is shocks, being able to, move monetary policy to a accommodative side if something happens. Looking at housing though, housing's the interesting one, because that's been the beacon of raise rates now, too much debt, housing prices are out of control, blah, blah, blah. But if you look at the back end of the year, we can see that the housing market probably peaked in August. So particularly if you look at the part of the market that really pushed it, which was Sydney, it's had since August consecutively, September, October, November, December data is out in the next couple of weeks, it has been declining fairly steadily by about 1%. So the housing prices in Sydney are showing signs of slowing down. The housing prices here in Melbourne, they have been starting to flatline. They haven't declined, but the growth rate isn't anywhere near what it was in January, February, March. Places like Brisbane, Adelaide, Perth have been moderated and have realistically not ever caught up to what's been going on the East Coast with Sydney and Melbourne. So there is that sign that the macro-prudential rules that the RBA brought in 2016 and 15 are filtering through. So that real push around housing is slowing down. The next side is debt, and that will be something you've also seen this year, is that the debt cycle has started to slow as well. Look at the banks. They've been telling you that their uptake of new loans has been moderating. It hasn't declined, but it's been moderating. Particularly then if you drill into the data, look at interest-only loans and look at investor loans. We all know what happened there. The banks have raised their rates independently of the RBA, but you've also seen a scenario where it's now more expensive to have an interest-only loan or an investor loan, and people are pushing towards principal and interest. And that too has just slowed that growth of debt down. It also means that the risk inside the debt is decreasing because people are now paying their principal off. So that would be one way of looking at it, is that this year has been the first sign since the housing-led recovery started in 2013 that there's just a slowdown of that frothiness, and maybe the urgency around the RBA raising rates is starting to push back, because we're actually seeing that the real heat in the market, housing clearly is the beacon of it, pushing back. The interesting thing that has been this year is that corporate lending has been fairly steady. It hasn't been what you'd call 2000 level mining boom sort of stuff, but it is picking up, and it is in mining. If you have a look at the cyclical parts of our market, materials have done well, mining services have come back and they're starting hiring people. So that has come through in the lending there. But interesting year for the RBA, and I think they're going to have another one next year as well.
And just to end off, we've got the mid-year economic forecast coming out next week, and some projections are that the budget forecasts will be, or the budget deficit forecasts will be lower. So it'll be interesting to see what comes out with that figure.
And they will be. I think that needs to be your base case. The government, particularly this government, has been fairly consistent and deliberately over pessimistic to sort of deliver a net political boost, as they all love to do. The reason for it is that if you have a look at in the assumptions of what was then the budget in May and looking into MyEFO that's coming next week, their average price, particularly of iron ore, is $58 US a tonne. It's clearly not going to be that. It's going to be roughly around about 61, 62 US a tonne. The other thing since the budget to now is that the Aussie has fallen away, so they get a double hit. The estimate that economists love to point, for every average dollar over, it puts about just shy of $250 million into the bottom line. So we're talking about, if it is $3 above, you're talking about just shy of $1 billion increase in the budget. Therefore, it will reduce that deficit. So it will be a bit of a kick, but again, take it with a pinch of salt. There are still structural issues inside the budget, and that's clearly what the politics will talk about, but it should be a better result next week.
We'll wait to see what happens.
Thanks, Tony.
Thanks, Evan. Join us again next time for the Economic View.